Hey everyone, my name is Christopher Kimball, and today we're going to be going over mortgage financing. So, mortgage is a type of loan. It has two parties involved, the loaner and the borrower. And obviously, the borrower is supposed to pay back their loan to, usually, it's a financial institution or a bank for the set amount, and that's done within set payments. So if you choose yearly, you pay a certain amount once a year, or if you go monthly, that's 12 payments per year. Once the mortgage is paid off, you're now the owner, free and clear, no strings attached, and you now own the property. Sometimes a mortgage is referred to as a liens against property or a claims on property. So keep that in mind if you ever see those other terms. But let's say that you don't want to do your payments or whatever it may be, you can't afford it, that the bank can seize the property or whatever you're mortgaging, and that is called a foreclosure. And those happen, and the bank takes it and does its own thing with it. We could go into it, but that's not the purpose of this video. So why do we use mortgages? Well, just how you use loans to pay for a car. Let's say you don't have 25 grand sitting around for that brand new Ford Fiesta or whatever your taste is in vehicle, then you get a loan. But a mortgage is kind of like that, but we're looking at hundreds of thousands of dollars. So $100,000 to $300,000, who knows? So you can get larger loans and you can pay them over longer amounts of time. So we're looking at 15, 30, 45 years, however long you negotiate the terms. So what are our options? There are obviously more than just three type of options, but we're just going to go over the three most common. There's a fixed rate, an adjustable rate, and a government insured. So fixed rate is same interest rate throughout the entire payment term. Let's say it's 8%, then you're stuck with that 8% throughout the entire time that you're paying it off. An adjustable rate is, it has a very low introduction interest rate, but after a certain amount of time, it's increased. And so just keep that in mind. I've written down the notes and the formula for how that's calculated, so feel free to look at that anytime. The third and last one we're going to go over is a government insured. So we have FHA loans, VA loans, and USDA/RHS loans. And they have their own different deals. So FHA, they're usually available to everyone, not just experienced buyers. And their advantage is super low down payments. So let's say that you have $200,000 that you need to loan. Normally you have 10 to 15% prepared as a down payment, so at least 20 grand sitting around as a down payment. But FHA loans go down as 3.5%, which is a pretty good deal. And then the disadvantage is that means that you're paying more per month, or mortgage insurance. So keep that in mind also. Veterans Affairs, VA loans, they're for military service members and their families. And the advantage is that you can get 100% financing, so you don't have to worry about a down payment. But the disadvantage is you usually have high interest rates. They're usually the highest interest rates that you can get in the United States. So be wary of that. USDA and RHS, they're more for agricultural use. So if you're a farmer and you're looking at getting a mortgage for land, then this is what you'd be looking for. They're usually the go-to for the farming industry. Anyways, if there's anything or any questions or concerns that you have, or if I didn't clarify anything, or you just want to double check my sources, these are the two sites that I was looking at, homebuyinginstitute.com and Investopedia, and they go over these subjects really well. Feel free to check those out. Anyways, that's all for today. We'll catch you later.